Well, I think there's a flight to safety. It's accelerating. Central bank purchases. Uh, in the first 11 months of 2024, we didn't get the December numbers yet, but it's the third largest in this century. I think we're witnessing, I guess you could say, a Bretton Woods 3, a new world monetary order. I think it's centered around more around currency-based, commodity-based platforms rather than fiat currency-based. De-dollarization, of course, is no longer a fringe theory whatsoever, and it's driven by a lot of things, mostly the weaponization of the dollar, but also the Federal Reserve's rapid policy shifts as well. They cause concern. In crises, the Fed inject a tremendous amount of liquidity into the system through quantitative easing and suppress interest rates. We've seen that. And the byproduct, when inflation starts to rise, or the other side of the coin, is they reverse course and with sharp rate hikes, and you can see the disruption that's caused. And now they're kind of caught in the middle. I think we can see commodity trades and settlement shifts in away from the dollar and local currencies and in gold, all certainly across the southern hemisphere. This erodes the demand for the dollar or the necessity to hold it. Facilitating trade settlement outside the dollar is really a big thing that I see increasing here in 2025 over things like Enbridge and its successor BRICS Bridge, because what the BIS did to the BRICS, Bank of International Settlement did to the BRICS at the 12th hour, and they're meeting in Kazan pulling out of Enbridge after 4 years of their innovation hub supporting it and helping develop it with China, Hong Kong, Thailand, the UAE, and then ultimately Saudi Arabia, saying at the 12th hour, we can't be involved with any countries that have sanctions like Russia, as if they just realized that R stood for Russia in the BRICS after 4 years of helping develop this program. It's espionage. To me, it's James Bond. It's right out of its Bond movie, and I think it will crystallize and reinforce the BRICS resolve. Regional trade agreements, obviously, that's we're seeing more of that. China buying corn, let's say, from Brazil, the second largest exporter of corn in the world, and soybeans, canceling the same time contracts with the US and Australia, buying it from Brazil, paying for it in yuan, settling in their local currencies, settling any trade imbalances with gold. It's happening in real time. These are all accelerating. In the United States market, lots to talk about here too. And I'll just go over it and then you can ask me any questions you have. One thing that really caught my attention, Peter, was already it's been a volatile start to the year, right? You got this Trump euphoria. And that's a dangerous thing in this environment because it's ignoring the fundamentals that were just so bad just a few short weeks ago before he took the presidency. Last Tuesday was the largest volume in the history of the NASDAQ. 13.4 billion shares traded. But what caught my eye was that it was record trading in US stocks under $1, valued at under $1. This is speculative mania when you're buying the penny stocks like this under $1. And it was the highest recorded day ever in trading stocks under $1. Interesting. At the same time, since Powell pivoted and lowered rates on the federal funds rate on the front end of the interest rate curve, we've seen 10-year yields shoot up. And this is the biggest ever move higher in interest rate yields post the first federal rate cut. So the Fed lowers rates on the front end, the 10-year shoots up the other way, the highest ever in history after a cut. And the 10-year, that's in the 10-year treasury yield after a cut. And it's never been like that, ever, which is a big deal. And that's the market's way of saying, no, we understand that you've chosen inflation over austerity. We will not hold any duration treasuries without a much, much higher yield. Of course, we have, by all measurements, record PE ratios, record CAPE ratio, record market cap to GDP ratio, record concentration in the 7 stocks. They're at or near all-time highs based on every available metric that you on Wall Street would have followed forever. And then you have, this super fragility, I think, where you look at the Russell 2000 or the Wilshire 5000, and the majority of these stocks are treading water barely, as 7 hold up the entire raft. And maybe this is why Warren Buffett's in $300 billion in cash and why central banks are buying gold. They see this. At the same time, by every single metric that we've ever used, we're either in or very damn well near a recession. You had the uninversion of the yield curve, which is predicted, I don't know, every single recession since the 50s. You have the SAM rule, Claudia Sam, where the moving average of unemployment goes up above 50 basis points above the 12-month moving average, something to that degree. It's predicted 9 recessions in a row. It was triggered. You have record money market growth, over $7 trillion in money markets, always characterized by a recession or running into a recession. And you have lower short-term rates, not long-term, short-term. And you lower short-term rates because it's not stimulus, but it's associated with recessions and to help revive an economy that needs its help as it's sinking deeper and deeper and deeper into this recessionary trap. But what really I think is something that, here again, when you look at what happened in 2020, no one would have guessed it. When you look at what could send things upside down, maybe the only people that understood that was State Farm Insurance Company, because these fires and the insurance problems are going to create a very big problem. Where's California to get the money to pay for these problems? According to, first of all, let's just start and go one by one. A lot of this I got from the Kobayashi letter, which is incredible. I want to give them props on this, but just to give you an idea of how bad this is, and is this the fuse that, and no pun intended, that sets the whole thing off. And that just came out of nowhere. I don't mean any disrespect to the people in Los Angeles and Palisades. In fact, my assistant, Megan, her family's home is gone. So it's not a laughing matter for sure. And they were in Palisades, beautiful home. Anyways, according to LendingTree, 10% of the homes in Los Angeles are uninsured. 75% of homeowners in Los Angeles do not have enough insurance to fully cover losses. The Los Angeles wildfires are now 38,000 acres and growing. That's 2.5 times the entire size of Manhattan. The estimated damage now exceeds $150 billion. It is the costliest wildfire in United States history. This is going to affect the California and the U.S. economy for a very long time. Could this be the tipping point that sends the economy spiraling, that blows up the insurance companies and the banks? Because right now you have over 10,000 structures that have been destroyed and growing. It's going to take estimated over 10 years to rebuild. But to put this into perspective, the Camp Fire in Paradise, California in 2018 was the previous costliest wildfire in U.S. history. In 2025 dollars, this fire caused $12.5 billion in damage. That's 12 times more expensive than the previous record, than the Paradise. And now 69% of homeowners in Pacific Palisades lost their home, and they do not have homeowners insurance. 69%, because homeowners insurance was canceled largely before the fire. Going into July, State Farm canceled 1,600 policies into July, just in that area alone. And so then you have this reliance on the FAIR Plan, which is the California-based pooled insurance program. It's an insurance pool provided to cover high-risk areas like this. It's a big deal because 40% of all of the folks in this program are in that Palisades area, 40%. And the numbers are expected to exceed $24 billion in claims. You had just a few months ago, Victoria Roach, the president of the FAIR Plan, saying, she warned to a legislative committee, she said, we don't have the money on hand to pay every claim, and we have a lot of exposure. They're in big trouble. So in 2023, Peter, there were 28 climate disasters causing 93 billion in damage. This is already, just since the weekend, is expected to be over 150 billion in damage and growing. The insurance companies are going to collapse. And the losses to the insurance companies are estimated to be well over $20 billion and growing. If you take the inflation adjusted dollars, this is 60% higher than the most expensive wildfire ever in the history of the United States. And they're spreading. You look at California Edison, the electricity company, they just lost $6 billion of market cap as of Friday because Bloomberg is saying that the wildfires, some of the wildfires are being caused by power lines that are blowing up and sparking. This is a problem that's going to grow to the umpteenth degree. And none of this stuff even begins to address and talk about what's happening with BRICS.